Alrighty guys, number 3 of 7 here is Amazon. Every investor's gotta own Amazon stock. This is a must own. By the way, it's random. I went on Google to search something and this popped up. Check out Jeff Bezos' new $80 million private jet. Jeff Bezos is no longer the CEO of the company, but Andy Jassy's running this show very, very well. Now, you understand with Amazon, this is a company in which they're way more than just that app or that website you type in to order stuff that comes to your house, okay? That's obviously a huge component of their business. But they're also devices and services. They're also Amazon Web Services, which is arguably the most important part of Amazon's business. They're delivery and logistics. They're one of the biggest delivery and logistics companies in the world. People don't think of it like that. But when you buy Amazon, you're basically buying like another UPS or a FedEx, right? Along with the backbone of companies in the internet, along with the biggest e-commerce platform out there, right? Incredible. Their entertainment. When you think about Prime Video, when you think about now they've gotten into live sports, right? Amazon Business, Amazon Luna. They also own Audible, Diapers.com. They also own Twitch, Zappos, Whole Foods. So when I look at Amazon, this is the definition of Amazon. They're a gold bar that just keeps producing more and more gold bars. And it's unbelievable, right? And when you think, Amazon started as one gold bar. It was a bookstore, an online bookstore. And to think what this company has produced you for the past 25 years is historic. It is absolutely historic. It's the definition of what I'm talking about in this video, of these gold bars producing more and more gold bars. That's Amazon. That's special. Now, here's, this is looking at 1000xstocks.com. This is our valuation tool where you can adjust revenue growth rates, net income growth rates to however you want. You know, you can switch all these numbers. I usually like to run my numbers with a consistent kind of what I'm thinking the company is going to likely grow over the coming years, right? So I'll usually run a consistent number, but you could put like 7 and 12 here and then like 5 and 18 or whatever, right? And what I want to draw your attention to here is I have them growing a very lame for Amazon, 12% a year over the coming years for revenue. Now, keep in mind, Amazon's grown far faster than 12% revenue. So this would be kind of disappointing. Now, this would put the company over $1 trillion in revenue in 2028, which could be the first company in history, human history, to reach $1 trillion plus in revenue, which I think is very possible. Another thing I want to draw your attention to here is I have net income growth at 15%. They're growing net income way faster than 15%. So this is a very sleepy number that I think they're going to probably beat that considerably over the coming years. But I wanted to go very conservative with my numbers just to illustrate the point of how much upside Amazon has over the coming years. Net income margins of 8%, which is not a high number here. Now, Amazon's a company that, you know, if you look at its history, it usually trades way over a 50 PE. But I want to go ahead and run a little more conservative, 35 to 50, right? Which is still very conservative considering if you're growing revenue double digits and net income double digits, right? So this would put the stock in 2028 at between about $286 and about $409, which on the low end would be a CAGR of about 13%. On the high end, there'd be a CAGR, a compounded annual growth rate of about 23%, which would be amazing. Now, keep in mind, this is my conservative numbers, okay? There's a high probability Amazon will come in and they will beat a 12% average revenue growth and a 15% net income growth. Okay, that's very beatable numbers. And net income margin, I think there's a real possibility they get this baby to 10% by 2028. But I wanted to run conservative numbers just to illustrate my point of how much upside Amazon really has over this next, we can call it 3 or 4 years. Now, Amazon's a very special company because this is one of very few companies that's built for all times. You know, you look out there, there's certain stocks that if the economy is really good, those stocks are going to perform tremendous. Their business models are special, right? For a great economy. There's certain companies that are positioned very well for like a recession situation. Like a company like, I don't know, a Coca-Cola comes to mind. Like they're going to still put up their numbers even in a recession. Amazon, this is a company built for all times. And when you think about all the different situations Amazon had to go through, the tech bubble bursting of 2000, the great financial crisis of 08, the 2020 Rona situation, right? Which was crazy and dramatic for them because people were forced to be home, which was kind of good for Amazon, but then they had to build out a ridiculous amount of warehouses because their demand went to the moon. It was incredible, right? And then 2022, which was a consumer goods recession because people said, I bought plenty of stuff in 2020, 2021. I don't need to buy stuff. I want to go on trips. I want to go on vacations, which was very negative for Amazon. And they got hit with inflation, which hurt them very bad with their delivery and logistics side. And yet they made it through just fine. Companies got really tight on AWS budgets, and they still made it through the other side. And they remained in a good place, right? And they came, and the thing you got to understand about Amazon, every one of these crises that the company has to go through, they always emerge stronger coming out over that next year or two than when they went as a company going in. That's a very special company. Because I can tell you, when a lot of companies are hit with hard times, they come out in a weakened state. And by the time you see that company emerging, you're like, ooh, that's a lot weaker company than when they went in. Amazon is one of the very few companies that you can say within a year or two coming out of a situation, like, that's a stronger company than when they went in. Coming in, they got a better expense ratio, those sorts of things. It's incredible. Now, it doesn't come as a surprise. Amazon's a big position for me, $186,000 in the public count. We're up $73,000 on this. It's a very small amount from what will be up in the future. Amazon and Meta, listen, man, these are steak and chicken. I always tell you guys, there's certain stocks that you got to build a portfolio around. You need your steak and chicken. They're the entree or your meal, and then you put the side dishes around it. That's Meta. That's Amazon. Special companies that you have to own for this next 10, 20 years. They're gold babies that will produce more. Hey, it's Jeremy. I hope you really enjoyed watching that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That's my advanced software that I've been working in the background creating for a long time. This software is so much more advanced than what others are presenting out there in the market. And as somebody that's been in the market 15 years, I want to create something that was simple, that had exactly everything I needed to make my judgments on companies, such as forward P ratios, 2-year out forward P ratios, price to sales ratios, forward price to sales ratios. I wanted the ability to be able to compare different companies versus each other. I wanted to be able to compare a Meta versus a Google versus an Apple and be able to see all those different metrics laid out all next to each other. I wanted a service that I could listen to conference calls right through and even be able to toggle and adjust the speed I wanted to listen to those conference calls. I wanted a service that I could search SEC filings right through. I wanted the ability to do that all in one service, and that is exactly what I've created with 1000xstocks.com. If you want to apply for access to this, go to the description area of this video. You can click that link and go ahead and apply for access to this. If you don't want to do that, you can go to 1000xstocks.com. Enjoy. Number 4 of 7 stocks up here is Shopify. Every investor out there should own Shopify stock. Absolutely is this one you gotta own. So, if I could only show you one thing about Shopify, this would be the thing I would show you. If I was only allowed to show you one thing, okay? So, this shows you how many people buy from Shopify stores over time. If we go back to 2016, they hit around 100 million Shopify buyers. Now, by 2018, they eclipsed 200 million Shopify buyers. By 2019, they hit around 300 million Shopify buyers, right? And then by 2022, there are over 500 million Shopify buyers. This past year, a little under 700 million. In 2024, they're going to be well over 700 million Shopify buyers. If there was only one thing I could show you, that would be the thing right there. Absolutely incredible. Now, in regards to Shopify, their earnings per share is flying up. It's not going to stop, really. Shopify's business model, I think, is one of the best business models in the world for producing exceptional margins and profitability over the long term. And the reason being, it's going to be a very asset-light business as this business continues to build out. There was a moment they looked like they wanted to take it asset heavy and kind of do an Amazon thing, but they kind of reversed from that and they're like, let's focus on our real strengths, which is being asset light, which is really on the software side, and making the purchasing much simpler. Doing anything through the digital way, which the digital way is the profitable way, right? Which is why AWS is what really contributes to the profitability of Amazon, this digital side, right? Now, look at this. This company is one of the very few companies you can pretty much expect them growing revenues 20% a year plus for years and years to go in the future. That's very special. Now, if we look at Shopify's revenue, check this out. Maybe if there was only one thing I could show you for Shopify, maybe it would be this. Their revenue went from, in 2017, under $700 million of revenue, to 2023, this past year, they did over $7 billion, over a 10x in their revenue in that amount of time. 2024, we'll see. It's going to be a big number. It could be $9 to $10 billion somewhere by the end of this year. Incredible numbers for this company. Now, With Shopify, they obviously make a lot of money from their subscriptions, which people sign up for the Shopify stores, and those stores could be very cheap. They could, some customers, some of the bigger dogs, they pay thousands of dollars a month to Shopify, if not tens of thousands of dollars a month to Shopify in subscriptions. Transaction fees is a way Shopify makes money. Shopify Pay is a way Shopify makes money, and there's a lot more babies coming in regards to this one. There's so many different avenues Shopify is going to be able to go over this next 5, 10, 15 years to produce more and more gold bars to make this company more and more profitable and more ways to make money. So Shopify is the number 3 biggest position in my Patreon portfolio. So if you follow me on Patreon, you get to see the stocks I'm buying and selling each week in that particular portfolio. And there's a reason it's the number 3 stock. So far, we're up 23% on the stock because it's a relatively new position, right? And I don't see that one, I need to continue to build Shopify. I need to continue to build that because I'm going to look back someday and be like, I remember buying Shopify in the 60s or the 70s or the 50s, and I'm just going to look back and be like, it was so cheap back then. Hey, it's Jeremy. I hope you really enjoyed watching that clip here today. What you're looking at in front of you right there, that's 1000xstocks.com. That's my advanced software that I've been working in the background creating for a long time. This software is so much more advanced than what others are presenting out there in the market. And as somebody that's been in the market 15 years, I want to create something that was simple, that had exactly everything I needed to make my judgments on companies, such as forward P ratios, 2-year out forward P ratios, price to sales ratios, forward price to sales ratios. I wanted the ability to be able to compare different companies versus each other. I wanted to be able to compare a Meta versus a Google versus an Apple and be able to see all those different metrics laid out all next to each other. I wanted a service that I could listen to conference calls right through and even be able to toggle and adjust the speed I wanted to listen to those conference calls. I wanted a service that I could search SEC filings right through. I wanted the ability to do that all in one service, and that is exactly what I've created with 1000xstocks.com. If you want to apply for access to this, go to the description area of this video. You can click that link and go ahead and apply for access to this. If you don't want to do that, you can go to 1000xstocks.com. Enjoy. All right, let's start reacting to some of these.
Is the target. We believe investors will be paying close attention to any signs that Autodesk is taking recent investor feedback into consideration and focusing on margins. They like the stock, Joe.
All right, so it's a turnaround story, and that's why they're advising readers to go out and buy it. I'm not ready to support the turnaround story. Yes, we own it. It's one of the many software names that we own, but there's been a deterioration in margins and the revenue growth. They've struggled. There's better names in software. A couple of names that are out there that we rarely talk about. Fair Isaacs, FICO. You could take a look at that. AppLovin, ticker symbol 8.
Fair Isaacs, is he talking about FICO? I think he's talking about FICO, which FICO is a very interesting one. FICO is a very interesting one. And the reason it's so interesting is that the growth has been very strong for this company. The valuation is extremely rich for the company. And you guys know FICO. It's a FICO credit score, right? But they kind of have a little bit of a borderline monopoly on the industry, and it's allowing them to have a lot of pricing power right now. And I mean, a lot of pricing power. So that's actually an interesting name. I mean, part of me feels like the stock's set up for potentially a big downward move next year.
We own that, the JOT ETF. It's up about 120% year to date. Commvault. So again, there's a distinction in software between who is executing and those who have been unable to execute because of a lot of the struggles in the cannibalization that AI is presenting.
Okay, Uber today, Surratt, reiterated a buy, Bank of America. Stock's getting a lot of love lately. Target's at $88. Strong traction for new verticals. We're expanding the company's TAM and network effects aiding margins. We think Uber will remain one of the fastest top and bottom line growers in the internet space.
So, you know, I loved Uber when I was in the 20s. I've cut back my position more than half of it now. I think it's done everything I wanted it to do. I'm a little concerned about delivery at this point to see if we get a slowdown in the economy, how that's going to work. I'm still holding my other half, but I'm actually looking to see potentially to get off the stock if it goes back to 75 to 80. Yeah.
You share any of that skepticism?
I want to say no because I've advocated so strongly for owning this stock. I've advocated for it, but I have to tell you the price action of the last 3 months, I mean, it's a roller coaster ride. It's going to a lot of different places and ultimately ending up nowhere in an environment where it should be doing better. So I don't know.
You got to watch out for Uber right now. You've got to really watch out. And I mean from kind of a negative angle in regards to Uber. And the reason being is Lyft is putting a lot of pricing pressure. If you have a Lyft app and the Uber app on your phone, you could go ahead and price out a ride right now if you want to somewhere in your city. And I say there's a high probability Lyft in, it looks like many markets right now, is significantly underpricing Uber, which, you know, not everybody's going to realize that, right? Because some people might only use, let's say, Uber, and so they don't even know what's going on with Lyft pricing. But the people that maybe compare between the two are going to see, oh, Lyft is, you know, significantly cheaper here. I'm going to take the Lyft ride, because a lot of people just view it all as the same. Like whether you get an Uber ride or a Lyft ride, it's all the same, right? And so this is an interesting dynamic, because if let's say just 10% of people do that, that significantly changes Uber's numbers. If even 5% of people do it, it still changes numbers significantly. And then Uber, do they respond with also going down in price? And then we get into a price war between Uber and Lyft again? I don't know. Or is Uber going to sacrifice some market share? I don't know. Like this is a big question. And so that's why I think Uber stocks had some trouble here recently. Is I think a lot of people also are kind of recognizing here that, oh boy, we might be in a price war.
It's more about concerns in Europe with economic conditions and the slowdown there. But I'd like to see Uber gain some momentum and propel itself back towards the March highs. There's been an inability to do so. That's why I share the skepticism surrounding the position, although we still own it.
You want to talk about DR Horton, which was named a top pick at Wells. Overweight, price target to 220 from 210. Risk reward best calibrated with torque on lower rates, but low ASPs offer defense against rising inventories.
You're reading a lot of these notes in the last couple of days. Lennar as well. It's Lennar, it's Pulte, it's NVR. Those are the four home builders that we own. There's a lot of strong momentum and optimism surrounding the home builder space, especially what we've heard from Vice President Harris in terms of how she could be incentivizing home buying interest. And then the simplest fact that we're going to see rates move lower.
What about Constellation Brands? Surratt, cut to 280 from 305. That's a price target slash. They do reiterate it, though, over at Morgan Stanley. They're over attractive valuation, still solid volume growth, well above its peers, but the near term, they're a little more cautious with negative catalysts. Do you see the same things?
I do. I'm also not as sanguine on the stock. I think it's done well. It's been great for us in our portfolio, but I think the beer, the wine, it's slowing down, and this could be a stock that, you know, we saw it with Budweiser, too. If the consumer slows down, this could be one of the things that could affect it.
Are you thinking about bouncing that, too?
I mean, hold on just a moment, okay? The Bud situation was very different than this Constellation Brands situation, right?
Bouncing that, too.
Wow. All right. You're a bouncer today.
For the
Chipotle, reiterated a buy, BTIG, price target, $67.
So everything that I read, talk with people about surrounding Chipotle says just continue doing what you've done while Brian Niccol was there. And they've built out a phenomenal team that understands what Brian Niccol thought the best execution strategies were. If in fact that's the case, I do not understand why Scott Boatwright is not the permanent CEO. Why does he need an interim tag? The man deserves to be the permanent CEO. It would give so much confidence to shareholders like myself that, in fact, everything we're hearing that we're fine. We're comfortable with it, what the strategy has been the last couple of years, and there'll be no change to it. Well, that would confirm it if he was the CEO.
So the board's doing what they should do. You've got a CEO that left. They basically have to go out and see what else is out there. They're not saying he won't be the permanent, but don't you want them to look and see maybe there's another Brian Niccol out there?
Okay, listen, I'm 100% out of my Chipotle put options, right? I thought it was over between me and Chipotle. I thought that was about that. If this stock goes running again into year end, I could come back in the next few months and end up buying Chipotle put options again. We might come back, baby.
Another Brian Niccol out there. The best alternative to Brian Niccol is the man that was sitting alongside Brian Niccol and observed what the strategies, the good strategies were for this company. That's the right person for the job.
Patience, Joe, patience.
Less food, less quality, higher price. I mean, that can make you a lot of money in the short term. I don't know if it's good for the brand long term.
What happens if this gentleman doesn't get the full-time job?
I would
stock
be,
or something?
I would be puzzled by that. Well, listen, Scott,
Depends who does get it.
Well, I'm saying
is the
Bernstein
answer.
Bernstein today says they reiterate also outperform. They go a little higher on their price target, $70. They say we dismiss the execution risk under new management. View the recent weakness as a good entry point in stock.
Okay, so for me, it personally troubles me that we don't have consistency in the management team. I want Scott Boatwright to be the CEO.
Okay.
Simple.
All right.
All right, next one up here. Both high-end and low-end consumers pull back on restaurant spending.
Highlighting the ongoing pressure consumers have been facing in the food sector. They say while financial conditions are tight for the low end, things have been pretty solid for the higher end, but both groups have started to show a bit of a reluctance to spending when it comes to eating out in particular versus eating in. A record 60% reported having reduced restaurant spending. 60% more say they plan to cut spending in the next 3 to 6 months. And this comes as credit card balances have been ticking upwards, which our next guest points out could lead to more moderation ahead. John Baumgartner is here. He's Mizuno's managing director covering the food and healthy living space. It's good to have you here. Let's start with, you've been doing this survey for how many years?
About 15.
15 years now. Okay, so with that experience, that track record coming into it, what stands out the most this year about the consumer?
I think it's really just the increase in pullback in restaurant spending. And we've seen it in the news, we've seen it in the financial reports, but seeing the broadening out, especially in expectations going forward, especially with the high-end consumer. We've known for a while now over the past year, the low end has really been reining it in on eating outside the home, but incrementally, the incremental pressure for the high end has really been a really big standout for us this quarter.
Do you draw a direct line from these results to kind of changing what you do with certain stocks as a result?
Not necessarily, but I think from a macro perspective, seeing that food volumes have been weak for much of the past year, seeing that degree of shift from restaurants into grocery, the calories shifting over, we have seen a very steady increase or improvement in restaurant grocery volumes since December. Volumes have been down 3.5%. Now they're flat. We do expect further improvement getting back to growth by the end of this year.
So I wonder if a little bit of this is kind of the timing. In other words, grocery prices shot up first. Consumers maybe in some cases switched to restaurant. Restaurant prices also been going up. I don't know if you have fast food in the mix, but that's one place in particular, but across the board. And so now it seems like people are shifting back, maybe looking to groceries. But is that shift enough to make you kind of...
So S&P restaurants up about, we can call it about 7% in the past year. And this just goes to show you, Texas Roadhouse and Cheesecake are really the crown jewels of the restaurant industry in general, right? Of like the sit-down restaurant industry. Because S&P restaurant up about 7%, Cake's up 28%, so about a 4x there. And then Texas Roadhouse up 62%. Oh my gosh. What is that, like an 8x, 9x there? That's incredible performance for Texas Roadhouse. So it really just goes to show you those two stocks. Like if you want to play sit-down restaurants, you got to play those two stocks. Those are the winner chicken dinners. And then after that, it's, it gets much tougher.
On those names, or are they still also under pressure?
No, we're bullish on food in general. I think there's a lot of concerns out there around price competition, discounting, but we're really seeing the pricing pressure is in restaurants. You're seeing deep value menus this summer. Labor costs haven't improved. Food costs haven't decreased at all. So, we see a lot more pressure in pricing in the discretionary space as opposed to consumer staples. And at the end of the day, folks have to eat. This is a very stable, sticky demand environment. Yes, you may have some months or quarters where market shares shift or volumes a little bit softer, but overall, we do expect continued growth in volumes.
I've been impressed, I guess you could say, that a lot of the consumer staples are trading at all-time highs. And granted, you have some names like Walmart and Costco in there, but even some of the... Okay,
so am I concerned about restaurant spending, given the consumer got hit by inflation for 3 years and we're kind of like, trying to climb back from that? So I could say maybe a little bit in the short term, right? But at the end of the day, as a long-term investor, I really don't care. Because the fact is, when it comes to something like restaurant spending, it's going to be up, it's going to be down, it's going to be all around over the long term, right? No different than if restaurant spending was insanely hot right now and the consumer was feeling great and we were at all-time high, real wages and all those sorts of things. It's an up and down cycles. And so as a long-term investor, you just got to understand sometimes the restaurant industry in general is going to be extremely great. Sometimes it's going to be bad. Sometimes it's going to be meh, it's okay. That's investing, right? At the end of the day, it's a great industry that I want to be in, but I got to be in the primo players, which if I'm going to be in those, I used to be invested in Texas Roadhouse a while back. I made a great profit on that, sold. Cheesecake continues to be a big position for me. I'm going to likely continue to build that position over the next several years, just to be quite frank. And so for me, I don't care. Like whatever. Short-term recession, unemployment goes 7%. It doesn't matter. It doesn't matter. Maybe it hurts the short-term numbers a little bit. So be it. That just gives me a better buying opportunity for the long term in those sorts of stocks, because those sorts of brands last through, they get out to the other side and everything's fine. So that's kind of my views here.